Hey guys! Here's another episode of Camera Too Low, Lights Too Dim, though I am actually making this video during the daytime now, so maybe the light won't be too dim. And today I'm actually hoping to make two videos, because the first video isn't about a stock, but the one coming up I'm hoping is going to be about Microsoft. But before that, this is going to be my third video to establish kind of my investment philosophy, just so you have a little bit of a baseline. If you watch this video, you'll kind of know where I'm coming at with these stocks. I know I've mentioned things like, in my past two videos, I mentioned I like paying attention to dividends more than a lot of other things, so that gives you a little clue there. But I just want to establish this, and I may touch on this later with a more in-depth video. But for now, let's just hop into it. So the three big things are led off by the number one, 10-year plus. I am a 10-year plus investor, investing over time. I am not a day trader, not a swing trader. If I buy a stock, I'm planning on holding it for many years into the future. If I buy it, I really just don't even have a plan on selling it. I do keep an eye on my stocks because things change. I had a sizable Facebook stock, sizable for me anyway, and just based on events throughout the past year and a half, I waited till a point where I saw I could get a lot of good value out of it, and I sold about a third of my stake. So I do sell stocks every now and then, but when I buy a stock, there's no end in sight. I buy it because I think it's a great company, and I'm going to keep it for a long time. The second thing that is big for me is I have to believe in a stock. And this one really bit me when I first started investing, because I think a lot of people that start investing have this issue where they find people they like. Um, so now it's YouTube, there's a lot of big stock market YouTubers out there, and a lot of them will even try and peddle this, hey, I have this list of stocks. And they won't say it outright because there's some legality issues to it, but you kind of get the impression that they're like, hey, here's these stocks. If you invest in these stocks, you'll make tons of money. And in some instances, that might be true. But in my experience starting out, if I invested, even if someone I was watching had a great track record, if I started investing in stocks just because they were investing in those stocks and not without actually believing in the company and liking the company myself, I would lose money. And even if I didn't lose money, I wouldn't be emotionally invested in that investment. So it would stress me out more. I would want to pay more attention, and I would be much more tempted to sell it if I thought something was going wrong. I guess a good example of this would be one of the YouTube stock market guys I like is Jeremy from Financial Education, and his stock portfolio and mine only share two stocks, I think. Elf and Facebook. I think those are the only two that we share. And that's not saying any of his other investments are bad. I believe a lot of his other investments are great, and they're probably going to make a lot of money, but they're not stocks that I really believe in or am excited about. One of the big ones is iRobot. Right now, he's big on iRobot, and he believes iRobot's going to be big and make him a lot of money, and it very well may. It probably will. It's down a lot right now, and I was tempted in watching his videos, like, ooh, maybe I should buy into iRobot, but in the end, I just have to assess myself about it, and it's not an industry I want to get into. It's not something I'm excited about, so I'm just going to pass on it. There's other things that I'm more excited about and willing to buy into, and I'll do those. So the third big thing for me with stock investing is dividends. I am a dividend investor. If a stock doesn't pay me money every quarter or however often, it better be a killer stock. So the only two stocks I own right now that don't pay me dividends are Facebook and Elf. Elf's big growth is about over. If Facebook can get out of these political mires and controversy, there's tons more money to be made in there, but I've already made a good bit of money. But Facebook's issue too is that it just fell out of favor. It went so long being the what's the golden child or whatever, that could do no wrong, and all of a sudden the 2016 elections came and there's been some shade thrown at it, and now Facebook just can't catch a break. But yeah, dividends. So, and it doesn't even necessarily have to be a lot. Like one of my investments is Visa. I've been holding Visa for quite a while now, and I've had a good return on it. And it offers dividends, not great dividends, but it does offer dividends, and that's something that kind of drew me into Visa to begin with, was a little bit of dividends with a lot of growth potential. So those are the three big things that I pay attention to, and then just kind of hitting the highlights of the little things. And this can get way more complicated. Like, I do read financial statements, I do pay attention to conference calls, but these four things are kind of the big ones that I look at. And the top one of those being a PE ratio. And I feel like people have stopped appreciating what a powerful indication the PE ratio can really be. Because it can vary a little bit from industry to industry, but what does a good PE ratio look like? Because in the past 5 years, you've had people looking at companies with a 30 PE ratio and saying, "Oh, that's a low PE ratio. Go buy that." Well, when is 30 a low PE ratio? Because really, it's not. 30 is not a low PE ratio. If a company has a PE ratio of 30, that company had better have some really good stuff going on in the future. Now, you can have companies like Tesla right now has a very like a 70 forward PE. At a 70 forward PE, that's honestly a little bit fair just because Tesla has so much going for it. But like right now, what's a company with a forward PE of 30? I think like Facebook is around 32. And that's kind of pushing it for Facebook, honestly. I think it has a lot more room to grow, but for where Facebook is right now, 30 is too high to be excited about buying into it. Another one, Microsoft. I'm going to make a video about this in a little bit, but Microsoft has a PE ratio of 20. Where Microsoft is right now, 20 is kind of high. It's too high to buy into Microsoft, really, if you're looking for value. Next up is going to be debt. So, debt is kind of a big one. Again, people's attitude about debt over the past couple decades, really, has just been awful. Because when you have people that are already graduating college with tens of thousands of dollars in debt and they don't view debt as a big deal, it can skew their view of how big of a deal debt is to an actual business. You can have a business that's profitable, but if they have tons and tons of debt hanging over them, what happens if there's an economic downturn? They're going to be stuck with that debt and they're going to lose a lot of profitability. That's really going to put a damper on their bottom line. So debt can be a huge negative indication for a company for me. And the third big thing I look for is leadership. So the CEO can tell you a lot about a company, and I have two examples for this right off the top of my head. One good, one bad. We'll start with the good one, that being Microsoft. Microsoft's CEO now, over the past few years, has had really good programs and really good vision to push the company forward. That's why even though Microsoft is not really a buy for me right now, I'm gonna keep an eye on it because news could come out that they're going to be having a good acquisition, and that just changes the whole game. But that's a really good CEO that has good forward vision and has a good track record so far with Microsoft. The bad example is Kraft Heinz. And honestly, I don't remember the name or anything, but not the current CEO, but the last CEO of Kraft Heinz, they brought a guy in to basically cut costs. And the way this guy cut costs was basically just to cut programs and products. What good does that do? If you have a CEO that's just cutting programs, entire products, he's not making the company really more profitable. Why not find a way to make those less profitable or maybe not profitable areas profitable? That's what a good CEO could do. Anybody can look at a company and say, "Oh, that's not profitable," and just cut it out. You need a good CEO to be able to lead you in the right direction. And the fourth one for me, which might be a little bit unique to me right now, though there's always bears out there. But resiliency. I do not have a good outlook on where the US economy will be in even 5 years. I think that in between 5 and 10 years from now, we may be in a pretty bad place. So, me being a 10-year plus investor and expecting us to be in kind of a rough place in 10 years, a company's resiliency is a big deal to me. So, what's an example? I have some utilities. Utilities are a good example of that. And something someone may not think of is Elf. Elf in itself is a little bit of a resilient company. It's still fairly new to the big market idea, but because it is a cheaper version of a product that everyone uses, it has the potential to actually gain customers in a down market. Women aren't going to stop using makeup, they're just going to buy cheaper makeup. So, Elf has a little bit of resiliency. But these are the basic things I look for. If y'all want a more in depth video about this, let me know and I will make it a bit sooner. But until then, y'all have an awesome day.